Welcome to ACCA Academy YouTube channel. In this lecture, I want to examine fair value adjustment in group accounts. Group accounts. Using question from ICAN May 2024 financial reporting question number 2. If you are coming across my lecture for the first time, make sure you like the video, share it with others, and subscribe so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you for being part of this channel. IFRS 3 on business combination. IFRS 3 on business combination requires that the subsidiary assets and liabilities are recorded at their fair value for the purpose of calculating goodwill and production of consolidated accounts. Fair value is synonymous. Fair value is synonymous with revaluation. Revaluation. That is, you revalue an asset. That is, to restate an asset to fair value, it means you should revalue that asset to their current market value of market price. So, to revalue an asset, you might have revaluation surplus, revaluation surplus, or fair value gain, fair value gain. And you may also have revaluation deficit or fair value deficit. That is, where the carrying amount of an asset, asset revalued, where it is less than the fair value, then you have the fair value gain or revaluation surplus. That means the fair value will be greater than the carrying amount. But if the carrying amount of an asset revalued, if it is greater than its fair value, that means you have fair value deficit or revaluation deficit. So I want to note that where an asset are revalued, the asset revalue will need to be adjusted to their current value. Remember, the principles in accounts is principles of double entry. Just know that you are going to apply the double entry. You are going to adjust two things. Adjustment required. Number one adjustment is the assets revalued, which could be plus or minus to that asset. So if an asset is revalued upwards, that means it will be a plus. Fair value gain is a plus, while fair value deficit is a minus. Take note of that. So the asset revalue, you are going to do a plus or minus to it. A plus for fair value gain or revaluation surplus. A minus for fair value deficit or revaluation deficit. Take note of that. Then number two adjustment is net assets at the DOE, date of acquisition. I'm particular about the fair value that arises at the date of acquisition. The same thing, if this is plus to this, that means it will also be plus to this. And if it's fair value deficit, which is a minus to the asset, it will also be a minus to the net asset at the date of acquisition. So for a fair value gain, add it to PPE and net assets at the date of acquisition. These are the double entry required for fair value gain. And if it is fair value deficit, that means you are going to subtract it from PPE. At the same time, you subtract it from the net asset at the DOA. This is the only double entry required where it is not a depreciable asset. But if it is a depreciable asset, then let me say for a depreciable asset, you are going to calculate that is for the purpose of statement of financial position, calculate the accumulated depreciation from the date of acquisition to the date of consolidation. That is, for the purpose of statement of financial position, the depreciation you need is the one from the date of acquisition to the date of consolidation. You have to identify the periods, how many years it is, or how many months it is, from the date of acquisition to the date of consolidation for you to be able to calculate your depreciation. So your accumulated depreciation now, accumulated depreciation, that will be your revaluation gain or deficit divided by the remaining useful life of the asset, and the remaining useful life of the asset from the date it is fair valued. You'll be told in the question times period from the date of acquisition to the date of consolidation. DOA mean date of acquisition, DOC mean date of consolidation. Take note of this. This is how you calculate the accumulated depreciation. Remember the depreciation adjustment. So depreciation, we used to charge it as an expense. That means you are going to deduct the extra depreciation on valuation surplus from PPE. From PPE, you know the assets that is revalued or fair valued. Subtract that extra depreciation from the PPE from that asset. And also from the post-acquisition retained earnings. In the summary of subsidiary net assets. Summary of subsidiary net assets. So these are the adjustments required. I'm talking about the revaluation that happens to the subsidiary asset at the date of acquisition. That is what you will need this adjustment for. So the double entry for fair value gain, you debit the PPE, you credit the net asset at the DOA. For extra depreciation, debit the retained earnings and also credit the PPE. That is the double entry. So if it is fair value deficit, it is the opposite. The reverse will be the case. Now let me just give you the format for the summary of subsidiary net assets with fair value adjustment. Summary of subsidiary net assets. The one with fair value adjustment, we have post acquisition retained earnings. You have the DOA, you have DOC. Please watch my earlier presentation for better understanding. So all these principles have been covered. So then you have ordinary share, The same amount you have in DOA will also be in DOC. This will be NIC. Share premium is usually the same as well. DOA. Then retained earnings. Retained earnings. The DOC may not be the same, so you have post-acquisition. Fair value surplus. The one that arises at the date of acquisition, that means you are going to have it in DOA, then you will equally include it in DOC. It will not be here. If it is a depreciable asset, you have extra depreciation on fair value surplus. You subtract your depreciation, then you deduct it from the DOC. There are a number of adjustments where you have integral transfer of inventory, where subsidiary is the seller. Because this is the summary of subsidiary net asset, where subsidiary is the seller. You will need the unrealized profit here. You subtract it, then from post-acquisition. Then where you have impairment loss, where policy is fair value. Where policy is fair value, you subtract impairment loss. So there are a number of adjustments I've considered in my earlier video. Please go back to those videos, watch them for better understanding. So you have this. Then your PP that will also required adjustment. You can have PP for parent. You know, used to sum up that of subsidiary. Then we have fair value surplus or revaluation surplus or fair value gain. Revaluation surplus. We add it. If it is revaluation deficit, we subtract it. Then extra depreciation, revaluation surplus. You subtract your depreciation. But if it is fair value deficit or revaluation deficit, this will be minus. Depreciation on it will be plus. Take note of that. So you have the PP that will appear in the consolidated statement of financial position. Now I want to take a question from ICAN May 2024 as a work example. Please keep watching. ICAN May 2024 financial reporting question number 2. The following are the statement of financial position of Sokoto Nigeria PLC and Niger Nigeria Limited for the year ended October 31st, 2023. We have for Sokoto Nigeria PLC and Niger Nigeria Limited. Non-current assets amount in 1,000 naira. We have plant and machinery 2,600, 560 for Sokoto Nigeria PLC and Niger Nigeria Limited respectively. Furnitures and fittings 1,600 and 400. Total of non-current assets is 4,200 and 960. Investment share in Nigeria Limited at cost 1,600. Current assets investment inventories at cost 1,760 and 560. Trade receivables 1,160 and 840. Cash and cash equivalent 800 and dash. Current asset totaled 3,720 and 1,400. Total assets 9,520 and 2,360. We have equity and liabilities. Equity 1 naira ordinary shares 5,600 and 1,360. Retained earnings 1,720 and 400. Total equity we have 7,320 and 1,760. Current liabilities, which include trade payables 2,200 and 440. Bank overdraft dash and 160. Total of current assets 2,200 and 600. Total equity and liabilities. This is total of current liabilities 2,200 and 600. Total equity and liabilities 9,520 and 2,360. Additional information. 1. Sokoto Nigeria PLC purchased 70% of the issued ordinary share capital of Nigeria Limited 4 years ago, when the retained earnings of Nigeria Limited were 160,000 naira. There had been no impairment of goodwill. Note 2. For the purpose of the acquisition, plant and machinery in Nigeria Limited with carrying amount to 400,000 naira was revalued to its fair value of 480,000 naira. The revaluation was not recorded in the accounts of Nigeria Limited. Depreciation is charged at 20% using the straight line method. Note 3. Sokoto Nigeria PLC sells goods to Nigeria Limited at a markup of 25%. At October 31st, 2023, the inventories of Nigeria Limited included 360,000 naira of the goods purchased from Sokoto Nigeria PLC. Note 4. Nigeria Limited owes Sokoto Nigeria PLC 280,000 naira for goods purchased, and Sokoto Nigeria PLC owes Nigeria Limited 120,000 naira. It is the group policy to value non-controlling interest at fair value. The market price of the shares of the non-controlling shareholders just before the acquisition was 1 naira 50 kobo per share. Required. A. Prepare consolidated statement of financial position of Sokoto Group as at October 1st, 2023. B. Explain how the investment in a subsidiary should be accounted for in the separate financial statement of the parent. Now, this question is obtained from ICAN May 2024 financial reporting question number 2. Now, let's have the solution to the question. The first thing is to draw the group structure. Group structure. You were told Sokoto Nigeria PLC purchased 70% of issued ordinary share capital of Nigeria Limited 4 years ago. So, parent is Sokoto. Sokoto Nigeria PLC acquires 70% of Nigeria Limited. Now, that is the group structure. Now, let me say working number 2. If this is working 1. Now, let's have summary of subsidiary net assets. Summary of Nigeria Limited. Nigeria Limited net assets. Summary of Nigeria Limited net assets. We are going to have post acquisition retained earnings. You have a column for date of acquisition. You equally have a column for date of consolidation. Amount is in 1,000 naira. I've told you that the net asset is equity. So an equity will have ordinary shares and retained earnings. That of subsidiary, ordinary shares is 1,360. Retained earnings of subsidiary is 400. You know, it is the summary of subsidiary net asset we need. So ordinary share 1,360. Retained earnings 400. 1,360 360. That is DOC. Retained earnings 400. So ordinary share retained earnings. Now, back to the note. You were told Sokoto Nigeria Limited purchased 70% of the issued ordinary share capital of Nigeria Limited 4 years ago. Acquisition is 4 years ago. So you will need that for depreciation purpose. When the retained earnings of Nigeria Limited were 160,000, the retained earnings at the date of acquisition, which is pre-acquisition retained earnings, is 160,000. There have been no impairment of goodwill. So pre-acquisition retained earnings is 160. So we have DOA 160. So the ordinary shares at the DOA will also be 1,360. So post-acquisition, 400 minus 160. So you have 240. That is the post-acquisition retained earnings. Back to note 2. For the purpose of acquisition, plant and machinery in Nigeria Limited with carrying amount to 400,000 was revalued to its fair value of 480,000. The carrying amount was 400,000 and it was revalued to 480,000, leading to a revaluation gain or revaluation surplus of 80,000. The revaluation was not recorded in the accounts of Nigeria Limited. So the revaluation surplus, the difference between the carrying amount and the fair value, which is 80,000, was not recorded. So when an asset is revalued upwards, the value of the asset will increase. That is why we are going to add it to the PPE. Since it is the plant and machinery that was revalued, you are going to add the 80,000 to plant and machinery for consolidation purpose, and then you will equally add it to the fair value of net asset at the date of acquisition. That is double entry. One entry, one leg of it goes to plant and machinery, that is PPE, and the other one goes to the fair value of net asset, making the double entry. So, revaluation surplus 480,000 minus 400,000, leading to 80,000. 80,000 at the DOA. This column is just a memorandum column. So these are the two columns we need. So since it has gone to here, every transaction will be entered in the DOC. They will move from DOC to either this column or to this column. Why do we need to add it to the DOA, date of acquisition? Back to the question. We were told, for the purpose of the acquisition, no, the essence of this fair value is for the acquisition. You were told, plant and machinery in Nigeria Limited with carry amount to 400,000 was revalued to its fair value of 480,000. Revaluation surplus. The revaluation was not recorded in the accounts of Nigeria Limited. So this transaction occurs at the date of acquisition. So that is why you have to treat it at the DOA, date of acquisition. Depreciation is charged at 20% using the straight line method. So since this asset is a depreciable asset, we are going to calculate the under depreciation or extra depreciation arises from revaluation. Let me call it extra depreciation. Extra depreciation that arises as a result of the revaluation surplus. 80,000 divided by, and you have to depreciate it at the rate of 20%. 20% using the straight line method. Remember, this fair value has arisen since the date of acquisition. Therefore, the depreciation to recognize must be the depreciation from the date of acquisition to the date of consolidation. The acquisition is 4 years ago. You were told Niger Limited, you were told Sokoto Nigeria PLC purchased 70% of the issued ordinary share capital of Niger Limited 4 years ago. The acquisition is 4 years ago. That means the depreciation to recognize must be the accumulated depreciation from the date of acquisition to the date of consolidation, which is 4 years ago. So we have 20% of 80,000 times 4 years. 4 years. So 20% of 80,000 times 4. The accumulated depreciation is 64,000. You subtract it from DOC. Remember, this depreciation, the asset will be depreciated. Since the revaluation took place at the date of acquisition, you can't depreciate the asset at the same very date of revaluation. So the depreciation will occur at the end of the period. So that means the depreciation relates to the post-acquisition period. Therefore, the 64, you are going to charge it in your post-acquisition retained earnings. That is note 2. Now, note 3. Sokoto Nigeria PLC sell goods to Nigeria Limited. Remember, we are dealing with the summary of subsidiary net asset. And the subsidiary is Nigeria Limited, not Sokoto. If Nigeria Limited is the seller of this inventory, then you will need the unrealized profits that arises from transfer of that inventory. You will need it here. But since the seller is Sokoto, you will not use the unrealized profit. You are here, you use it in the consolidated retained earnings. Now, let's leave this. Note 4. Nigeria Limited owes Sokoto Nigeria PLC. This is the intergroup receivables. So, intergroup receivables, you will not need it here. 5. It is the group policy to value non-controlling interest at fair value. This is the policy. And you are given the note 6 is the market price per shares of NCI. So, these are the information that will affect the summary of the subsidiaries' net asset. Now, let's roll it to total. 1,360 plus 400 plus 80 minus 64. Then you have 1,776. Then DOA column 1,360 plus 160 plus 80. Then you have 1,600. For post-acquisition retained earnings, you have 240 minus 64. Then you have 176. 176. That is the summary of subsidiary net assets. Now, let's start the consolidation. The name of the parent is Sokoto Nigeria PLC. So now we have Sokoto Nigeria PLC Group. Sokoto Nigeria PLC Group. Consolidated statement of financial position as at October 31st, 2023. You start with assets. The first asset to start with is plant and machinery. Plant and machinery, not current assets. plant and machinery. That of Sokoto is 2,600, while that of Niger 560. 2,600. Let me add K for the 1,000 plus 560,000. Remember, we have a fair value of 80,000, which arises at the date of acquisition. And we said it will be added to the PPE, plant and machinery. At the same time, this fair value resulted in a depreciation of 64. Depreciation will also be subtracted. So we have plus 80,000 minus depreciation of 64,000. So we have 2,600 plus 560 plus 80 minus 64. So we have 3,176. 3,176. Then after plant and machinery, the next asset is furniture and fittings. Furniture and fittings. That of Niger, that of Sokoto 1,600. Niger 400. So we have 1,600 plus 400. Then you have 2,000. We do not have any note on this. Working 3. Acquisition of Nigeria Limited. We want to calculate goodwill on acquisition. To calculate goodwill, we start with purchase consideration or consideration transfer. Purchase consideration. How much is the consideration? If you look at the statement of financial position, that of the parent, you have investment there, which is shares in Nigeria Nigeria Limited at cost 1,600. So we have 1,600. You also add the fair value of non-controlling interest at the date of acquisition. Go back to the note 5. It is the group policy to value non-controlling interest at fair value. The policy is fair value. You were not given the market price of the shares of the non-controlling shares holders just before the acquisition was 150 kobo per share. So the fair value of NCI. How much or what is the number of shares acquired? You know, you have 1,360. 1,360 divided by 1 naira. The par value is 1 naira. It will still be 1,360. Where the par value is not 1, so the value will be different. The number of shares is what you need. To get the number of shares, divide the nominal value by the par value. So you get the number of shares. Now, the NCI will be 30% since the percentage of acquisition what parent acquired is subsidiary is 70%. That means NCI will be 30%. So you have 30% of what is the equity of subsidiary? Ordinary shares. 1,360. You know the number of shares is what you need divided by 1, which is 1,360. So we have 30% of 1,360. Okay. Times what is the par value? The market price per share, the market price of the shares of the non-controlling shareholder just before the acquisition was 150 kobo per share. So the market price per share is 1.5. 1.5. So now let's calculate this. 30% of 1,360 times 1.5. So we have 612. 2. If you add 612 to 1,600, then you have 2,212. 2,212. From this, you deduct the fair value of net assets at the date of acquisition. You get this figure from the summary of the subsidiary net assets. The DOA summary of the subsidiary net asset is 1,600. So you have 1,600. If you subtract 1,600 from 2,212, so you have 612. 612. That is goodwill. This is positive goodwill. Goodwill. So now, for consolidation purpose now, we have goodwill. That is working number 3. We have 612. So if you sum it up, 612 plus 2,000 plus 3,176. So we have non-current assets total 5,788. After the non-current assets, then you have current assets. Current assets. Number 1 current assets we have include inventories. Inventories at cost 1,760 and 560. So we have inventories 1,760 plus 560. We have a note as regards the transfer of inventories. Back to the note. So you were told that Sokoto Nigeria PLC sells goods to Nigeria Limited at a markup of 25%. At October 31st, 2023, the inventories of Nigeria Limited includes 360,000 of the goods purchased from Sokoto Nigeria Limited. It is 360,000 that is still in the inventory. If you have watched my earlier presentation on intragroup transfer of inventory or intragroup trading, I've told you that the unrealized profit should be calculated on the unsold portion of the inventory. So that means you calculate your unrealized profit of 360,000, the one that is still in the inventory of the purchaser. Now, this is markup. The profit calculated on the cost price is markup. Therefore, this is the transfer price of the item bought by Nigeria Limited. So since this is the transfer price, which is equivalent to the selling price, you will need to convert from your markup to margin. So markup of 25%. So we have 25 over, if you convert markup to margin now, you have 25 to 100 in the denominator. So you have 25 over 125 times 360,000. So minus unrealized profit 25 over 125 times 360,000. So we have 25 divided by 125 times 360,000. The unrealized profit is 72. So if you have 1,760 plus 560 minus 72. So you have 2248. 2248. That is inventories. Then after inventories, you have trade receivables. Trade receivables. Trade receivables. You have trade receivables. That of Sokoto 1,160. That of Niger 840. Now let me show a working for that. Working number 4. Working 4. Trade receivables. You have Sokoto 1,160. 160, 1,160. That of Niger, that is 840. Nigeria Limited owes Sokoto Nigeria PLC 280,000 for goods purchased. Niger is owing Sokoto 280,000. That means to Nigeria Limited, this 280,000 is a payable to him. While to Sokoto Nigeria Limited, it is a receivable. And Sokoto Nigeria PLC owes Nigeria Limited 120,000. To Sokoto, this is 120. This is payable. Why to Nigeria Limited, it is receivable. So in this case, this is different from a situation by they were owing 280,000 and someone has sent certain amount which it was in transit. This is different from that situation where you may be having inventory in transit or cash in transit. Remember, in this question, the question did not tell you that the difference relates to either inventory in transit or cash in transit. So you are going to remove this from both the receivables and payable. Then you remove this from receivables and payable. So we have owes by Nigeria Limited. That is 280. So remove it. Owes to Nigeria Limited 120. No, that's same 120. It is this 280 is a receivable to Sokoto Nigeria Limited. Why it is payable to Nigeria Limited? Why this 120 is a payable by Sokoto, why a receivable to Nigeria Limited. So if you like, you can call it intergroup receivables. Both are intergroup receivables. So what do now have as the difference? 1,160 plus 840 minus 280 minus 120. So you have 1,600. So you have trade receivables, 1,600. So that is working number 4. Working for 1,600. After trade receivables, you have cash and cash equivalent. Cash and cash equivalent. So cash and cash equivalent, 800. 800. We didn't have any note that affect that. So 16 plus 800, that is 24, plus 2248. 248. So you have 4648. 4648. So if you add this to your non-current asset, you have plus 5788. You have 10,436. This 10,436 is our total assets. Total assets. Equity and liabilities. Equity and liabilities. Our equity includes 1 naira ordinary shares, that of the parent only, 5,600. 1 naira ordinary share, parent only, and that amounted to 5,600. Then we have retained earnings. Retained earnings. Let me have that as working number 5. Working 5. Retained earnings. So you start with the parent retained earnings, and parent is Sokoto, Nigeria, PLC. Retained earnings as per statement of financial position. And how much is that? So we have retained earnings 1,720. 1,720. We have Sokoto, Nigeria, PLC, share of adjusted post acquisition retained earnings of Nigeria Limited. No, the parent stake percentage of acquisition is 70%. 70% of how much is the adjusted post acquisition retained earnings? So from the summary of net assets, we have 176. So 176,000. So 70% of 176,000, we have 123 approximately. Then we now have provision for unrealized profit. So transfer of inventory 25 over 125 times 360,000, which have been calculated earlier. 25 over 125 times 360,000. And we have adjusted this in our inventory. 25 divided by 125 times 360,000, we have 72. So we remove it. Because parent is the seller, that is why we are deducting it from the consolidated retained earnings. If subsidiary is the seller, we will have adjusted that figure in the summary of subsidiary net assets. So we have 1,720 plus 123 minus 72. So we have 1,771. 1,771. So retained earnings is 1,771. So if you add it to 5,600, we have 7,371. After this, we have non-controlling interest. Non-controlling interest. Let's have that as working number 6. Non-controlling interest. Then, to calculate non-controlling interest, we start with the fair value of non-controlling interest at acquisition. Working 6, non-controlling interest. So you start with fair value of NCI at acquisition, which have been calculated earlier. So we had 30%, or if you just look at where we have the workings for goodwill, this is the working, fair value of NCI. So 30% of 1,360 times 1.5, and we got 612. 30% of 1,360 times 1.5, and we got 612. Now have NCI share of adjusted post acquisition retained earnings of Nigeria Limited. So NCI is 30%. What is the adjusted post acquisition retained earnings? We have 176. So 176, 30% of 176. We have 53 approximately. If you add 53 to 612, you have 665. 665. That is non-controlling interest. 665. So if you add the 665 to 7371, so we have 8,036. That is total equity. Total equity. After total equity, we have current liability. Current liability. Current liability, which include trade payables. Trade payables. We have 2,200 plus 440. 2,200 plus 440 minus, I've told you, note 4. This 280 will be payable to one entity, and this 120 will also be payable to the other. So minus 280 minus 120. So we have 2,200 plus 440 minus 280 minus 120. So we have 2,240. Let me put it here, 2,240. Then we also have bank overdraft. Bank overdraft. And the bank overdraft, that amounted to 160. 160. So if you add the 160 to 2,240, so we have 2,400. 2,400. So the 2,400, which is your liability, current liability total, or total liability, you add it to the total equity. Remember, our total equity is 8,036. 2,400 plus 8,036. So we have 10,436. 10,436. That is total equity and liabilities. Total equity and liabilities. So that is all about the first part of the question. Now, the second part of the question, you have to explain how the investment in a subsidiary should be accounted for in the separate financial statement of the parent. How the investment should be accounted for in the parent company separate financial statement. Investment in subsidiary should be accounted for in the separate financial statement of the parent at fair value, which at the date of acquisition should be the sum of the assets transferred by the acquirer, liabilities incurred by the acquired to former owners of the acquiree, and equity interest issued by the acquirer. So you account for the investment in subsidiary at fair value. Please mark the end of the solution to the question. Please drop the love emoji, like the video as well, share it with others, and subscribe. Thanks for watching ACCA.